Can cryptocurrency help the Fed fight inflation? What is cryptocurrency? A cryptocurrency is a digital currency, which is an alternative form of payment created using encryption algorithms. The use of encryption technologies means that cryptocurrencies function both as a currency and as a virtual accounting system. To use cryptocurrencies, you need a cryptocurrency wallet. These wallets can be software that is a cloud-based service or is stored on your computer or on your mobile device. The wallets are the tool through which you store your encryption keys that confirm your identity and link to your cryptocurrency. Recent events. Following a massive multi-trillion-dollar asset price boom that catapulted high-growth stocks and crypto prices into the stratosphere, Elliott has warned, people need to brace for a seriously adverse unwinding of the everything bubble, pointing to a number of frightening and seriously negative possibilities. This year, global stock markets have recorded losses of $28 trillion, according to data compiled by Bloomberg, while the Bitcoin and crypto market has seen $2 trillion of value erased. The S&P 500 has dropped 20% since its 2022 peak, with the Nasdaq down by 1/3. FTX was one of the world's largest exchanges for digital money called cryptocurrency. FTX's problems worsened over the weekend and threatened the entire industry. Sam Bankman-Fried founded FTX in 2019. He grew the trading firm quickly by attracting the biggest investors in Silicon Valley. Last week, FTX declared bankruptcy. Bankman-Fried resigned. The firm said money had disappeared. And experts say hundreds of millions of dollars may have been lost. The collapse of FTX is a shock to the cryptocurrency industry, which has seen a fair number of problems this year. The outcome of FTX's bankruptcy is uncertain, but its failure will likely result in the destruction of billions of dollars of wealth and create even more doubts about cryptocurrencies. The top U.S. banking regulator at the Federal Reserve is urging Congress to pass legislation that would impose regulation on cryptocurrencies in the wake of the swift collapse last week of FTX, a leading crypto exchange. Michael Barr, the Fed's vice chair for supervision, said in prepared testimony released Monday that recent events in crypto have highlighted the risks to investors and consumers associated with new and novel asset classes, and activities when not accompanied by strong guardrails. Barr, who took office in July, is scheduled to testify before Congress Tuesday for the first time as vice chair. He did not refer specifically to FTX in his written remarks. Bitcoin, the world's biggest cryptocurrency, has dropped about 65% in value for the year. And Ether, the world's second most valuable cryptocurrency, lost 20% over the last weekend, per CoinDesk. The Fed moves forward with digital currency amidst inflation. U.S. inflation, recently rocketing into double-digit percentages, has been blamed on pandemic-induced supply chain disruption rather than the Fed's ultra-loose monetary policy, something Elliott analysts have branded dishonest. In the U.S., consumer prices are rising at a pace not seen since the early 1980s, with inflation soaring to 10.1% in September, up from 9.9% in the year to August. Some other countries around the world have seen an even steeper rise in prices. Cryptocurrency and blockchain technology have become a major factor in the financial world over the past decade, after initial skepticism from mainstream institutions. Although private cryptocurrencies and stablecoins have been in a deep decline since peaking a year ago, the technology behind digital tokens has attracted interest from both private financial institutions and central banks across the globe. Central bank digital currencies, CBDCs, are the digital token format of fiat money issued by central banks and could be exchanged between financial institutions to improve existing clearing and settlement processes. Official acceptance by the Federal Reserve of digital dollar tokens could possibly improve the efficiency and speed of the global financial system. Michelle Neal, head of the New York Fed's Markets Group and an executive committee member, told Reuters that use of a central bank digital dollar could speed up the settlement time in currency markets. Many central banks around the world have already announced that they were developing or were considering the future use of digital currencies by the public, including issuing their own CBDCs. At least 112 countries, representing more than 95% of global GDP, are exploring a CBDC, according to the Atlantic Council. The three-month project, which the New York Fed calls the Regulated Liability Network, or RLN, will be conducted in a test environment using only simulated data, reported Reuters. The RLN program will simulate digital money representing the deposits of the banks, customers, and settle them through simulated Fed reserves on a shared distributed ledger. The participants will suggest further improvements at end of the program to assess how use of digital currency could become a feasible possibility in the future. The project will also test the feasibility of a programmable digital money design that is potentially extensible to other digital assets, as well as the viability of the proposed system within existing laws and regulations, according to the press release. However, many critics are concerned that a digital currency maintained by a central authority could lead to a loss of privacy, similar to what is being planned by the Chinese. Not to mention, crypto was initially created to be anti-government.